Hello and welcome. We come to you today with a breakdown of a recently closed hedged bond trade from our income and arbitrage strategy. The recap of this trade will be of interest to anyone who wants to protect their capital, particularly in today's difficult economic environment, but who is also looking for regular income and moderate capital growth. The Takata Income and Arbitrage Account, by combining income investment strategies with various arbitrage strategies, offers an alternative investment approach uniquely tailored to today's market conditions. In the current economic environment, with yields painfully low, some securities in bubble territory, and others appearing cheap but languishing, it is hard to know what to do. But we have found a solution for investors seeking capital protection and yield. The solution is in purchasing corporate bonds with insurance in the form of put leaps, basically put options with a longer-term orientation. The integrity of this hedge trading strategy is based on the fact that in the event of liquidation, bondholders have a superior claim on the assets of a corporation to that of equity shareholders, as explained in our video, What Are Bonds? In any default scenario for the company where we are at risk of losing money on our corporate bonds, the common share value must be zero, because the high-yield bond is senior to equity in the capital structure. In owning insurance on the full amount of our bond exposure in the form of put contracts on the equity, we have protected our capital in the event of default. A successful trade with Allied Nevada debt executed last year and closed out earlier this year brought our focus to other opportunities in the hedged bond universe. The Allied Nevada trade I referenced was set up initially to provide us with a 9% protected yield. The interesting thing is that Allied Nevada got themselves into trouble and filed for Chapter 11 protection. As a result, our return on this investment was plus 39%. But how did we achieve it? Well, we achieved this return of 39% through the interest we received on our Allied Nevada bonds, achieving full value for our Allied Nevada puts, the residual value in our Allied Nevada bonds, and some currency benefit. This opportunity is repeatable with some other credits that meet certain technical criteria, such as 1. The bond trading at a large discount to par, and 2. When long-term equity put options are available and can be purchased at a reasonable price. As a theoretical example, let's say we are interested in the senior 7.5% 2019 maturity bonds of the toy manufacturer Funko, which are trading for 50 cents on the dollar. We note that Funko stock trades at $5 per share and has put option contracts exercisable at $3 per share, expiring in 2 years' time. These put contracts can be purchased for 60 cents per contract. If we buy 21 of these put contracts for 60 cents, we have purchased 21 times $3 or $63 worth of capital protection. The cost of the bond is $50 and the cost of the puts is 21 times 60 cents or $12.60. Therefore, the total cost of the trade is $62.60. In this case, we have secured $63 worth of capital protection for an investment that has cost us just $62.60 and are therefore 100% plus hedged. The current yield on our investment is the 7.5% bond coupon divided by our $62.60 cost, or 12% for the duration of the put coverage. However, in the event that Funko's business undergoes a recovery during this time, the return may be higher than the current yield of 12%, the bond price rising as investors gain confidence in Funko's ability to continue to meet its debt obligations. In the event of default in which there is no residual value left in the bonds, the full insurance proceeds received from the put contracts will offset the loss of capital on the bond, and the investor will only profit by the cash flow received up to the point of default, i.e. the 12% per annum. In most default situations, however, the company is not liquidated, but rather reorganized. In the case of our Allied Nevada investment, for example, it is proposed that the bonds we own will form a continuing part of the capital structure of the company when it reorganizes itself and emerges from bankruptcy protection. Often the bondholder will exchange their claim for a negotiated package of new securities that could include cash, new bonds, and/or equity. Whatever the case, you can be assured that the bondholder will not receive less than the stockholder in a reorganization, and this incremental residual value will improve the profit on the hedge transaction beyond the cash flow, as it did with Allied Nevada. What's more, the bonds will continue to trade and reflect some part of this residual value throughout the reorganization process, offering an opportunity to liquidate the position for profit, as with Allied Nevada as well. And if necessary, the puts can be rolled forward at any time to extend the default coverage beyond the 2-year period. However, rolling the puts forward involves an incremental cost which will reduce the yield somewhat in subsequent years. In summary, a high-yield bond on its own can be a risky investment, while put options on their own are a speculative tool that can also be used to hedge. Combine the two and you have a low-risk source of income that is indifferent to whether a company thrives or fails. A portfolio that includes such hedged yield investments must be built with care, one opportunity at a time. But when fully invested, such a portfolio can deliver an attractive gross yield with only modest capital risk. Thanks for watching, and as always, if you have any further questions, please do not hesitate to give us a call or visit our website.